Starting, all attendees are in listen-only mode.
Button so that you can watch a replay of it later if you need to get into some of the detail a little bit more. So I want to welcome everyone. My name is Tyler Bollhorn. I'm the founder of Stockscores.com. I wrote the book that you see there on screen. Incidentally, if you want that book, it's only available from the Stockscores website right now. So you can go there to look at that. I think you can read the first chapter or something online. So what are we going to do today? The goal is to show you things that can help you be more profitable in the stock market. And I have found that the simplest things work the best, and that's what we will focus on. I've also found that if you do what everyone else does, you really shouldn't be expected to do better than average. If most people are doing the same thing, then that's average. We want to beat the market. We want to be better than average. So we have to be a little bit open-minded. Some of the techniques that I show you maybe are things that you will have not heard about in the past, but they are effective. At the end of today's presentation, I'm not going to actually analyze stocks. I'm going to analyze the overall market. Because of the correction that's been underway for the last couple of weeks, I think a lot of people are wondering what's next. So at the end of this presentation, I'm going to do the analysis of the overall market. And I'll give you some things to watch for because I think there's a real opportunity to buy the bounce. But ultimately, the longer term outlook perhaps not so positive, and some things you can do to protect your portfolio. So we'll do that at the end. So the itinerary, we're going to first talk about what is trading, and then I will go through my 10 principles, how you can learn my methods for analyzing and trading the stock market. And then, as I said, we will look at that stock market correction and what is next in terms of where we're going to go short term and longer term. And then at the end, I'll also take your questions. If you have questions, you can type them in anytime, but I'm not going to pause and answer questions in the midst of things. I find that it hurts the flow a little bit. So I will answer questions at the end. All right, so what is trading? Essentially, trading, as opposed to investing, is buying and selling while the stock is moving faster than the overall market. I'm looking for identifying stocks that are doing better than most, that are moving faster than the market. So if the market moves up 8% in a year, I want to find that stock that moves up 12% a year, or better yet, 50% a year. I want to find the stocks that have something called alpha, which is disconnect from the market's trend and really outpacing the trend. Now, we can trade in many different time frames. You can be a trader in terms of your mentality and still hold stocks for months or even years. It's not just short-term trading, although many people will associate the term trading with day trading, and that's something that you can do as well. I often day trade. In fact, that's what I do most days. But trading is really a mindset about just holding stocks when they're working, and then when they stop working, move out of them and move on to the next one. It's really less about what the company is doing and more about the stock's trading activity, its trend, how abnormal it is trading, things that are clues that that stock is going to outpace the market. And we'll cover off a lot of those today. So a trader looking at this stock, this is Canada Goose, which trades on the Toronto Stock Exchange. A trader would say, okay, we're going to buy here and ride this trend and sell here. And then we're going to buy here and ride this trend and sell there. And I will show you some of the ways that I do that, but that's exactly what my strategies would have informed us to do. You know, getting into the market when it's moving quickly, but really staying out of the stock when it's moving sideways, or worse yet, when it's moving lower. And that, of course, is a longer term chart. That's a 1-year daily chart, but we can also be a trader in a very short term time frame. Friday was a big sell-off day, and yet this was a stock that triggered the rules for one of my day trading strategies. And the signal to enter was right there. And in just the matter of a few hours, the stock went from $14.50 to $15. It's a pretty decent percentage gain for a large cap stock on a day when the overall market was really getting pummeled. here's a stock that still managed to go higher despite the market weakness. And we'll come back to those and show a little bit of how we identify those as I go through the presentation. So finding alpha, that is principle number one. As I said earlier, alpha stocks are trading on their own story. They're the stocks that lead the pack in the market. It's kind of like an alpha dog, you know, in a pack of wolves, there's the alpha dog that leads them to wherever they might go. In the market, the alpha stocks are leading the trend. They are trading on their own story. They have significant changes in their fundamentals, and that really allows them to outperform the overall market. Now, I will tend to talk today about only buying stocks, but you can actually make money from stocks going down. You can make money from markets going down. There's a lot of money to be made in the last 2 weeks from the market going down. And so when we talk about alpha, it doesn't necessarily mean a stock going up faster than the market. It could also be a stock going down faster than the market. We can make money both ways. Most people will only be buyers, and so that's why I'll focus on that today. But many of the strategies I do are long or short strategies. We don't really care because you can make money either way. Now, I've been using the same method for finding alpha for almost 30 years. And I'll tell you a little story about how it came to be that I use this method. I was a university student at the University of Calgary, and I was taking a finance class in the business program. I think it was a fourth-year class. And in that class, we studied the mergers and acquisitions of the 80s. So I was in university in the late 80s, early 90s. And at the time, there was a lot of mergers and acquisitions in the United States. And these mergers and acquisitions would cause the stock price to move up very quickly. And so there was a real interest in how can you predict the stocks that get bought out by another company. If you can imagine a stock trading at $30 a share, and another company says, we're going to buy you entirely for $50 a share. If you owned it before the news came out, you had a very nice profit, right? And so we looked at all these mergers and acquisition deals and found that almost all of them had evidence in the trading activity in the market that someone knew that that deal was going to be announced. These stocks started to trade abnormally before the news came out. And so the market was really telling us that A, people knew, and that B, we could follow what those people were doing simply by following market activity. And I've really based my entire trading career on that simple concept. I've developed statistical models, algorithms that look for the footprints of alpha stocks. And as I go through the presentation, I'll show you some of that. And I've also spent a lot of time and even more money building my own tools to find these things. They're very expensive to build. They're very expensive to run. And that's really the basis for the Stockscores website and a lot of the things we do at Stockscores. It's all about using math and algorithms to identify trading opportunities. And as I go through today, I'll show you a little bit of that. So how do we find alpha? Well, one of the footprints of alpha is abnormal activity. So returning to the first chart that I showed you, which is Canada Goose, we had an alpha day or an abnormal day right here. And you can see that the volume traded that day and the price movement on that day was abnormal. And if you had looked at that stock on that particular day, it would have been easy to see that. What I built was a tool that allows me to scan the entire market looking for stocks that are doing that. And that's called the Market Scan tool. It's available on stockscores.com. I'll talk about that in a bit. So I look for alpha by looking for abnormal activity. And I'll tell you a very simple rule that is very, very important. Almost every market-beating stock will start its market-beating trend with abnormal activity. However, not all abnormal activity leads to a market-beating trend. You can see here, there was abnormal volume and abnormal price action, and that was pretty close to the top. The stock ultimately went lower. It was here that it was really important because that started that really strong trend that the stock went on from $32 to $90, almost a 300% gain in less than a year. And the clue was the abnormal activity, and that's our alpha signal. Now looking at this day trade from Friday, similar situation. We have abnormal price action, abnormal volume, and it started a market-beating trend that only lasted a few hours, but considering what the market did on Friday, that was a very strong alpha stock. It outperformed the overall market quite handily. So how do I find alpha? Well, I have tools. If I'm doing anything longer term, longer than a day trade, I will use the Stockscores Market Scan tool. We take in data from all the exchanges in North America, and we run algorithms on them and look for stocks trading abnormally on the daily interval. And from that, we can find trading opportunities that will typically play out over a few weeks or months as these stocks are moving on their own story. For shorter term trading, I use some specialized software called TradeStation, and I commissioned some indicators to be written for TradeStation. Basically, I devised the math and then had some talented programmers program it for me. And that allows me to find things like those day trades where I can find stocks very quickly. About 2 years ago, I think, I launched a new service called Active Live where I do all the work for the short-term trader. You can actually watch my screen as the analytics are being run every 2 minutes. And it identifies all the stocks that are trading abnormally on the US markets. We're only able to cover the US markets with TradeStation. I can trade the Canadian market from the market scan for longer term trading, but for day trading, I tend to focus on the US market because that's where most of the opportunity is. And I really don't care whether it's US or Canada. There's no other difference. It's just a symbol as far as I'm concerned. So I'll just quickly show you the market scan tool. I'll go over to the Stockscores website here and go into market scan. And I can select a scan that looks for abnormal activity. So abnormal breaks US, run the market scan. And it went through every stock that is listed in the US market, and it found 17 that made an abnormal price gain with abnormal volume. And I can then view the charts of those to do my final bit of analysis, which is looking for certain patterns in the chart. And as I go through these charts, I'm looking for something pretty specific. I don't expect I'll see much on Friday because of the sell-off. That one's not bad. Upside probably only to 1080 though. So that's the process. I run the market scan. I look at the charts for certain patterns that I've learned differentiate the stocks that make abnormal activity and will do something good and those that won't. And there are telltale signs and chart patterns that I can teach you, but it takes a little more time than what we have today. And that's things that are covered in some of the education that I have on the Stockscores website. And this really comes down to this concept of algorithmic trading. It's buying and selling based on rules that have been tested over a very large sample size of data. So for example, I have a database of all of the stocks that have met the rules of my day trading strategy going back to the start of March. And there are, I think, over probably close to 40,000 trades in that database from on the long side and maybe 28,000 on the short side. So I have this huge amount of data. Every day I have the computers calculate data and it all goes into a big database. And from that, we can find out what works. Not what works like once in a while, but works consistently over literally thousands of trades. And the rules are actually not that complex. It's the data analysis where it really gains value. And so, for example, that day trading strategy on the short side tends to average about $100 of profit for $100 of risk taken. In other words, it has something called positive expected value. I won't get into the weeds too much, but that's going on in the background. When I talk about, you should buy here because it's breaking through this pattern, blah, blah, blah. Some people will say, well, that makes no sense. I really only trust fundamentals. But realize that when I say those things, it's based on math and based on very large data sets. And anecdotally, probably the best support of algorithmic trading is this. The most successful investor of the last 10 years, many would say, is Warren Buffett. It is not. It's a guy named, well, a couple people. One is named Jim Simons, who is an algorithmic trader, started a hedge fund more than 10 years ago, I think maybe 20 years ago, called Renaissance. And Here's a guy that I think started with about $1 million of capital. His personal net worth is now over $10 billion. Ken Griffin, similar story, started a company called Citadel, which is a large algorithmic and high-frequency trading firm. And again, multi-billionaire from simply using math and using statistics to identify opportunities that work well over time. And so once you find a set of rules that work well over a large data set in the past, then we can start to apply them to future opportunities and try to get the results that we expect from the past. We won't always get the exact same results. There's the potential that what worked in the past won't work in the future, but I've been doing the same thing for 30 years and it's pretty consistent in its ability to identify hot stocks. So my strategies focus on alpha stocks and I use rules and processes to find them. And it's really, 5 rules, apply them over and over again, and it spits out candidates, and some work, others don't, but they tend to work well over time. Principle number 2, don't fall in love. And so I'm not a cold-hearted person, but it is important to recognize that humans are predisposed to fail in the stock market because we are emotional and we have to suppress our emotions. Algorithms help us by making the process mechanical with logic-based rules. And what it helps us to do more than anything is take out the emotions so that you don't ignore a stock that is giving a sell signal. You are essentially following a set of rules that works well and not really getting wrapped up in the story and not getting too close to the company. Because if you do that, your judgment will be clouded. For example, I like Apple products. I have a phone. I have on my desk here one of those home pods. I don't have their computers because they're not great for trading, but I've got lots of Apple products. So you could say I'm an Apple fan. I don't own Apple stock because I don't think right now is a good time. Not that it's a bad time either, but doesn't fit my rules. And so, my approach is to not buy stocks that I like. My approach is to buy stocks that will make me money. And that's really what matters the most to me. All right, principle number 3, and that is to have an edge. There are millions of people with trillions of dollars competing for returns in the market. And we shouldn't fool ourselves. It is not a level playing field. There are some that have an advantage in the market through their experience, their knowledge, their tools, their processes. A lot of them just get better information. To beat the market, you have to have some kind of an edge. Otherwise, you're going to get eaten for lunch by those who do have the edge. And there's many different edges in the market. My edges are that I've developed my own tools that are quite sophisticated. They're not things that are used by a lot of people. I don't give access to my tools to a lot of people. And because of that, they don't lose their value. I've also got processes in place to find things before most people do. So if you think back to that day trade, for example, on the Brazilian petroleum company, the symbol's PBR.A, I found that within 2 minutes of it starting to move. Most people might not catch it for much long after me. And the reason I can catch it early is because I've built processes and tools to find it before the crowd. And I think my other edge is that I have experience. I've traded for almost 30 years and I've been through every kind of market. I've learned all the lessons the hardest way, which is to lose money. And from those hard lessons, you start to see that certain things work over time and other things don't. And so those are my edges. All right, moving along to principle number 4, and that is don't fight the trend. You can't overcome the power of the crowd, even if the crowd is wrong. So you can say, it makes no sense that the stock market should be going up as much as it has. And I've heard that argument for the last 10 years because we've been in a 10-year bull market, almost 10-year bull market. And yet, time after time, the market just keeps moving higher. And a lot of people have tried to rationalize it and say it makes no sense. And yet, it keeps moving higher. And so sometimes the problem isn't that you are right or wrong. The problem is you're not looking at the right information. A lot of the trend higher is something I spoke about on the radio today, which was the buyback programs, which is trillions of dollars of stock being bought back by public companies, has really perpetuated the trend. And artificially low interest rates are behind that. And so, yes, earnings, company earnings aren't really getting better, but earnings per share have been getting better because of these buyback programs. So we always want to trade with the trend, not fight it, just do what the market tells us to do. I always like to use the metaphor about paddling a canoe on a river. You can paddle with the current or you can paddle against it. And obviously it's a heck of a lot easier to paddle with the current. And so we always want to trade with the trend. For the last nearly 10 years, the trend has been up. In the last month, the trend has been down. And so the trend you use when you're gauging what you should be doing depends a lot on your time frame. If you're a long-term investor, then really the last month should not matter a lot yet, because we haven't really broken the monthly trend line, although I'll talk about that in a moment. We might. We'll keep an eye on that, but we'll talk about that at the end of the presentation. So gauging the trend is pretty simple. We start off with something called inflection points, and that allows us to define the trend. All right, so chart's going to come up, and I'm going to draw on this chart. I'm going to draw some inflection points. Inflection points occur anytime you have a low point or a high point. So just think in terms of peaks and valleys. So anywhere you can sort of find the pointy parts on the chart, you've got peaks and valleys. All right, and I can draw lots of them on here. And then all you do is connect the dots. So I can start at this low point and just kind of cut a line across those inflection points, and I've defined an upward trend line. Pretty simple. The inflection points are like the dots, and you connect the dots. So we can draw one across the tops as well. So there is a trend line across the tops. And the way these lines come together tell us a lot about what the market is thinking. First of all, if there's an upward trend like we had there, we have optimism. The buyers are winning the war in the market. We also had a horizontal line of resistance, we call that. And that is an upper boundary of what investors felt this company was worth. They said, based on all of the information we have about Canada Goose Holdings, we don't think it's worth more than $50 a share. And that held up for 1, 2, 3, almost 4 months. Then right here, we had a breakout through that ceiling price. So now you have a group of investors who say, we think that this company is actually worth $52 a share and more as it started to move higher. Well, what you have to wonder is why people would say that. And the reality is people get better information, they act on it in the market, and that causes these big price moves. And so understanding trends starts with inflection points. So again, just draw your inflection points on the chart, connect the dots, and then look for a breakout from those patterns. You can do that on an intraday chart as well. So here we have a trend that is moving higher and getting actually steeper over time. That's called a parabolic trend. As long as that trend is in place, we should be long of that stock. And unless the trend is broken, we would not need to exit that trade. Okay. Moving right along, principle number 5. Our number one goal is to maintain and preserve your capital. If you are investing in the stock market and you don't have capital, you're out of the game. So our number one priority is to have a risk management strategy that will preserve your capital. And so for every trade that I take, I always know what my downside is. I plan for it. I say, if I buy this stock and it goes down to this price, I'm going to get out. And I use that difference, the difference between the entry price and where I plan to get out, as my risk. So let's say the risk on a trade is $1 per share. And if I'm willing to lose $500 on one trade, I would buy 500 shares. And so we determine our position size from the risk of the trade and our risk tolerance. If you're willing to lose $100 on a trade and it has a $1 a share risk, then you would buy 100 shares. So it's a pretty simple calculation. What's important, though, is where you put your stop loss point, where you define that exit door. And again, that's a more involved lesson, something that I can teach to people, but pretty simple concept. If it comes down to that point where the market proves us wrong, we got to jump out and not take a big loss. Preserving capital, number one goal, principle number 5. Principle number 6 is know your risk tolerance. How much are you willing to lose on any single trade? And that not only is based on how much money we have, but it's based upon our age, how close to retirement we are. I think more than anything, it's based on our emotional limit. What allows us to sleep well at night? You could have $1 million, a $10 million portfolio, but if it bothers you to lose $1,000 on a trade, then you got to keep your position sizes small. Some people will have a $10,000 portfolio or capital base and be willing to lose $1,000 on a trade. I would say that's pushing it a little bit on your capital preservation goals, but it really comes down to what your risk tolerance is and how you trade around that. If you exceed your risk tolerance, you will make emotional decisions. And so one of the key things that I want everyone to take away from this principle is that emotion is the enemy in our investing. When we are emotional about our investments, we make irrational decisions. It's actually quite scientific. When you get fear, it kicks a part of your brain in called the amygdala, and it causes you to do irrational things. And it's only later, when the emotion of the decision wears off, that you realize that you did something foolish. So it's really important to do what we can to keep the emotion out of our decision. And one of the key things is to not take more risk than we are comfortable with. So if we return to this example, we can define risk a little bit better. So let's use this point here as our entry point and this point here as our stop loss point. And so I'm going to round off just for the sake of simplicity, but we'll call the entry at $32 a share and the risk or the stop loss point at $25 a share, maybe 26. So let's call that $6 a share in risk. Okay, the difference between our entry price and our stop loss price is $6. If we're willing to lose $150 on one trade, then we might buy 30 shares. 30 times 6 is 180. Let's round it off. Let's call it $200. 180 plus commissions, maybe $20 in commissions equals $200 in risk on that trade. Now, as the stock moves up, we can start to gauge its performance based on risk-reward multiples. And some of the webinars that I do next week, which you can join in on as well, I'll get into this in a little more detail. But in this particular case, if we sold there, which was the sell point, that was 1, 2, 3, 4, 5, 6 times risk. It earned us 6 times what we risked. So it earned us $1,200. So we made a reward for risk of 6 on this particular trade. And again, I'll get into that in more detail on some webinars I'm doing on Tuesday and Thursday next week. You can go to the Stockscores website and register for those later on. Now, day trading, we can do the same principle. Enter here. You see these lines are already drawn for us. I've automated a lot of this stuff with my indicators for TradeStation. But in this case, this trade made 8 times risk by the end of the day. So our entry price was here, stop loss point there, and it made 8 times. We actually don't put our stop loss there. In this particular trade, our stop is there, but our risk reward multiple based on the capital risk was 8 times the risk. Okay, principle number 7. Not every trade works. We need to accept that. When we're investing in the market, doesn't matter how good you are, you will lose some of the time. And so you need to have a philosophy of getting out of your losers, but also not buying more of a loser. Now, some people talk about averaging down, buying more of a stock. If it's not working, buy some more. I have no idea why it makes sense to put more money into a trade that's not working. The market's telling you that you're wrong, and yet people will tend to buy more and more of a stock that's moving lower. And it's really a fast way to go broke in the market. So principle number 7, never buy more of a loser. Buy more of a winner. If you have a trade that's working and it's trending higher, sure, buy more, even on little pullbacks in the trend, but don't add to a loser. Big losses are hard to overcome. And when you add more and more to a loser, yeah, sometimes the trend will reverse and you kind of trade your way out of a bad position. But I've seen people completely blow up their accounts because they average down and keep buying more of a bad trade. Principle number 8, learn first. Trading is simple, but it is not easy. Another cliche I like to use is that the stock market is cruel because it gives the test first and the lesson after. So if you have aspirations of being a short-term trader, or you want to manage your own investments for the long term, find someone with the experience to teach you how to do it. It will save you time. It will save you money. When I started trading, there wasn't really a lot of people out there teaching how to trade the stock market. This was a long time ago. There was people teaching how to trade the futures market, but very little about how to trade the stock market. So I taught myself. It took me 8 years before I became successful. I was a student. I was, going through the finance program at the University of Calgary, and I taught myself how to do things that I can teach anyone in much less time. So where it took me 8 years, I can teach you the same thing in 2 months. It saves time, it saves money, but make sure when you find a teacher, you're finding someone who actually does it, not someone whose primary business is teaching. I always like to say to people, if the marketing is too good, they're probably a seller first rather than a trader first. Principle number 9, have a plan. All traders should have a concise, logic-based plan for when to buy, when to sell, or when to short and when to cover, risk management controls, a process for identifying trades, rules that keep the emotions out of the process, and those rules should be based on a large amount of data. If it doesn't work through different market conditions, through many trades, not that it's going to work on every trade, that's not our expectation, but it should work over 100 trades or over even 1,000 trades. If it works consistently over a large number of trade samples, then it starts to make sense to apply it. And that plan, by having a written plan, and I recommend if you have a one-page concise written plan for how you are going to approach the market, now you've got something to go back to when that part of your brain, the amygdala, gets aroused because you have fear, like maybe has happened in the last month. It's a way to keep yourself on track and not lose sight of your rules. Principle number 10 is practice. I can teach anyone my rules. I could write the rules for my strategy on the back of a napkin, but actually applying them takes practice. It's no different than, learning a sport. I have a 6-year-old son. We were at the hockey rink this morning. He's practicing every morning. Not every morning. Saturdays is his game day. He's out there practicing, and he's better this week than he was 2 weeks ago because of practice. And it's no different for stock trading. You have to get out there and practice. But what I really stress is that you don't have to practice with real money when you start. In fact, you shouldn't. I don't care if you have $10 million to invest. Start a rules-based approach to investing and trading by simply paper trading. I have a simulator that I'll make available to my students where they can go in and just practice trading in an environment where it tracks their results. And if they're successful in the simulator, then they're ready to start trading with a small amount of risk, maybe $50 a trade in risk, and then increase that to $100 when they've made money at $50. And then they've made money at $100 of risk, now increase it to $200. What you're doing is you're practicing, number one, but you're also building confidence. You're slowly increasing your risk so you keep your emotions out of it because you slowly desensitize yourself to that capital risk. And ultimately, you're just going to make better decisions. So for those who want to learn my approach, I teach my strategies and processes to a small number of people each year. I don't teach it to a lot. 50 to 100 people a year is all. Only my students can use the tools I've developed. I really don't want a lot of people to use the tools, because if thousands of people use them, they don't have the same effectiveness. People often ask me, if you're investing and trading well, why do you teach? There's a few reasons. First and foremost is the money I get from teaching. It means that I don't have to take money out of my trading account, or not necessarily as much money out of my trading account. I'm no different than anyone else. I have to pay bills, and I'd rather have a business that helps people instead of, make $100,000 in the market in a month and have to pull some of that money out to pay the bills, right? Second reason is because I teach people, I actually am a better trader. It forces me to really make my rules concise. When you have to teach someone your rules, you really have to analyze them. And I think I've become a better trader. A lot of my students have actually helped me. In particular, some of my students who are programmers have helped me develop my strategies to a higher level, and that's been a big benefit. And then, the last thing is a little bit of altruism. I enjoy helping people with that. Trading is kind of a solitary business. I sit in a small room and with all these computers in front of me. I don't talk to people during the day. And so by teaching, it's a little bit of a social aspect where I can, do something that helps other people, but in a sense, it's helping me as well. So if you want to learn more, there's a few things that I can help you with. First of all, we have some free webinars coming up next week. For those who have an interest in becoming a day trader, there will be a webinar on Tuesday at 6 p.m. Pacific time. And you can register for all of these webinars on the Stockscores website in the upcoming events area. On Thursday, I will do one focused on investing, so longer term trading, not day trading. And then on Saturday next week, I will do more of an in-depth overview of our different training programs. I'm going to just give you a high-level overview today, but if you want more detail on that, we have information on the Stockscores website, and I'll do a more in-depth overview next Saturday. To register for these webinars, just go to the Stockscores website, go to the Trader Training menu, select upcoming events, and you'll see the registration there. And they're all free events. So I'll give you a very quick overview of what we do at Stockscores to help people learn. We have something called the Stockscores Education Center. It's split up into 3 areas. The foundation area teaches the theory behind what I do, and there's very good theory. There's been Nobel Prizes won on the theory that I use in my investment approach. And then there's the investor section, which are the strategies, the rules, the processes for investing in the market. And then there's the active trader section, which are the rules and processes for what we call day trading and swing trading. Day trading, holding positions within a day, swing trading, holding positions for typically less than 2 weeks. All of that is online. You watch videos, there's lessons, there's tests that you can take. And throughout that whole process of learning, I'm available to you to answer your questions via email. The investor course, we have 3 course options. The investor course gives access to that theory. It gives access to my investment strategies, which are really appropriate if you're managing your retirement portfolio, let's say. You have an RSP, you have a TFSA, you want to know how to pick stocks for those things. That's what I will teach you, how to find the stocks that have good potential. I think the most important benefit of the investor course is it's the only way to get access to my market scan tool. I, don't want a lot of people using that tool because it loses its value the more people use it. So that is how you get access to that tool. It also, with that course, you get email support from me as long as you are a member of Stockscores. I personally answer all the email. I can do that because I don't teach too many people. And so, I sit in front of my screen all day trading. I answer email pretty quickly as well. It gives you access to my Stockscores tools, that market scan tool, for free for 6 months, and then you can renew your access for $300 a year once you are a member. The Active Trader course gives you everything I just talked about, but it goes one step further, and that is access to my active trading strategies. So these are my day trading, swing trading strategies. You still get access to the market scan tool, but you also get access to some real-time indicators and algorithms that I've created for TradeStation. And we have a new tool called Active Live where you can actually watch my trading screen, my analytical screen, the same screen that I watch to identify my day trades through the day and swing trades. I basically do a webinar of that every day. So you can see my screen. That's only available to my active trader students. It's something you have to subscribe to, but it gives you that real-time access to the same screen I'm using via a webinar. I come on in the morning, have a little comment before the market opens to give my outlook for the day. I don't talk a lot through the day. I'll sometimes come on and make a comment. And then at the end of the day, the final half an hour, I sort of do a review of the trading day, what signals we got from the algorithm as they came up, and summarize the performance. Every day I summarize the performance of the previous day, and we can monitor that performance. If you want to know how well these strategies perform, come to that day trader presentation on Tuesday, because I will actually show you the performance of the strategy going back to the start of March. The active live service is only available to Stockscores active trader members. It's $195 a month, and essentially I do all the work for you in terms of the analysis so that you can focus on making your own trades. Now, the final training option is something called the mentorship program. It is a 12-week hand-holding program, essentially. Every week for about an hour, I will do a lesson like I'm doing today, but much more in-depth on a different component of the active trading approach. The mentorship it would be helpful for the investor as well, but it's really not targeted at that. It's targeted to the person who wants to maybe make a career out of day or swing trading the stock market. And so I will walk you through the educational material one-on-one in a small, well, it's not one-on-one, I guess it's a 1 versus 15. There's only 15 spots in the mentorship program. And so you sign on Tuesday at 6 o'clock. Typically we might do a seminar or a webinar, and I will teach risk management that week. And then the next week I'll teach the process for identifying day trades, things like this. And by having me walk you through it, you really, A, get forced into learning it, and B, get to see exactly what I do and ask questions. And it takes a lot of the difficulty in learning. I think it makes it a lot simpler. There's no more information in this than there is in the active trader course, but it's, I think, a little bit more in depth. In addition to the 12 weeks of education and hand-holding through the learning process, you also get a private one-on-one meeting with me. We do it online via a webinar, but we talk. We actually have an audio back and forth, and I'll just work with you on things that you didn't understand, maybe helping set up your trading screens, whatever you need. You give me a little bit of an outline before our meeting of where you feel your weaknesses are and what you need me to help you with, and then I come to that meeting prepared to help you on those matters. I have a daily email where I send out trading lessons every day and trade examples every day, 5 days a week, and you'll get that for 3 months as well. Now, this mentorship program is very popular. I only do it once a year. I do not know if I will do it next year. I don't want to be committed to that, so don't think that you can do it. It's possible. I just don't want to commit to it today. So there's only 15 spots available, and because I open it up to my existing students first, there are now 7 spots remaining. So I have 8 people that have already registered for this in the last couple of days. So there are currently 7 spots available for the mentorship for the program that starts November 20th. So I'll just quickly summarize the live trading that's coming up. I'm going to complement the normal live trading or the normal online trading with some live sessions, and that starts November 10th. So 2 Saturdays from now, I think, November 10th. In the morning from 9 till 12 Pacific time, I'm going to do a class where we walk through the theory together. So that's a 3-hour class. I'm just going to go through how to draw trend lines, what support is, what resistance is, all of these aspects of my method that you need to understand. So that'll be Saturday, November 10th. And then we're going to do 3 nights of market scanning together. Monday, November 19th, Wednesday, November 21st, and Thursday, November 22nd. We will meet online. It'll be a webinar like this. You will see my screen, and we're just going to do scanning of the market on the Stockscores website to try to find stocks that fit the rules. So you will have already learned the rules. You will then practice them with me. And the first night, I kind of do it all for you. The second night, I make you try to pick the stocks as we're going through the the stocks that I find, and then I'll come back and review them with you. It's a super way to learn because it's without the benefit of hindsight. It's actually looking at trading opportunities that come up that day. Now, for those who do the Active Trader course, you can get a free month of my Active Trader Live service. It's up to you when you want to use it. You could use it in December. If you signed up today, you could use it in November, I suppose. I recommend that you learn first before you join Active Live. So to me, the best month to start would be December, or even wait until January. But it's, seeing my trading screen live as it happens with a little bit of commentary from me. And you get a free month of that service if you purchase the Active Live course before November 8th, which is the special offer that we have. Anyone who registers for the Investor or Active Trader course prior to Thursday, November 8th at 11 p.m. will get that Saturday overview class and then the appropriate strategy application series included for free. So the overview class, Saturday, November 10th. For the Investor people, the market scanning sessions, 3 of those, Monday, Wednesday, and Thursday, later in November. And then for the Active Trader group, you get a free month of the Active Trader course whenever you want. You just have to email me when you're ready to do that. So here's the course pricing. This is all Canadian dollars. The Investor course, $2,495. The Active Trader course, $3,495. It includes everything in the Investor course as well. And the mentorship with that 12-week program complementing what you get with the Active and Investor course is $5,495. And all that, again, in Canadian dollars. I guarantee you it will cost you more to learn what I teach you. It took me 8 years before I was successful in the market. I can teach you my rules in, well, I would say 8 to 12 weeks if you are willing to put in the effort to learn. So I'm going to quickly just run a little poll here. I always like to do a follow-up email, but I don't like to bug people. So if you don't want the follow-up email, then you don't have to say yes to this. Doesn't matter to me. So I'll just launch this now, and just do me the favor of answering that. Yes, which one you're interested in most. And if you're not interested in any of it, say no thanks, and I will try not to bug you. I do hope that some of you will come back for the webinars that I'm doing next week. They will go a little bit more in depth into my approach. The day trading webinar is on Tuesday, the investor webinar Thursday, the course detail webinar on Saturday. But again, if you just quickly answer this, then I will have some statistics. Now, I am recording this, and so if you are watching the recorded version because you couldn't get in here today, then you can email me if you want some follow-up on any of these programs. Obviously, you can't answer the poll if it's a recorded version. But I'll give this another 10 seconds and then I'll shut it down. And we'll move on to the next step. Okay, so I'm going to close this now. Just wondering why it's not going away. There we go. Pardon me. Okay, so for those who would like to register for the course right away, you can do so at the, sorry, I'm trying to get my screen up here. There we go. At the Stockscores website. If you go to that page that I have there on screen, stockscores.com/learn, there's a few videos on that page as well that teach a little bit more about what these courses are all about. I've done a very high level overview. Next week, I'll actually get more in depth into what they are, how well these strategies work, that kind of thing. If you are interested in doing the mentorship, as I said, there's just 7 spots available. You should email me and let me know that you would like to join, because once it's full, it's full. So my email address is there on screen, tylerb@stockscores.com. The email the mentorship is super popular, and it tends to sell out pretty quickly. So if you would like me to walk you through the process and have that one-on-one learning session with me as well, then probably better not to delay too long. But I welcome questions. I don't do high pressure sales. It's not my style. So if you just want to ask me some questions about the mentorship or any of these courses, email me. I will answer them as best I can. And there again, follow me on social media. Twitter, my handle is @Stockscores. The Stockscores YouTube channel, very popular. Each week I do a market analysis, and I have just done that this morning, so it will be up. I think it's up on YouTube already. So go to the Stockscores YouTube channel. It's free content, lots of good education there. All right, I promised that I would talk a little bit about the correction and where we are. So we're going to look at a few charts here. And this is a very short-term chart. This is a 30-day, 60-minute chart, and it tells us a lot about the emotion in the market. So you can see that we have been moving lower since October 4th, and we've had these gyrations where we fall away from the trend line and then come back to it, and then we fall away and we come back to it. We fall away and come back to it, and we fell away on Friday morning and started to come back to it, but didn't quite close up to it. So this is something called a parabolic downward trend. It shows that investors are getting quite emotional. And when investors get emotional, they make mistakes. So I would say that going into next week, the market is quite oversold, and that means it's likely to bounce. It wouldn't surprise me if we get a real flush on Monday morning, perhaps some strong weakness on the open Monday morning, but we're close to the point where that weakness shouldn't last a lot longer because we are oversold. And when we look at the next chart, we are also nearing some support. So this is now the daily chart. So here we have the daily trend line, and same principle. Price runs away, it comes back. Price runs away, it comes back. Runs away, comes back a little bit. We finally broke that 2 or 3 weeks ago, and we are now in a sharp downward trend, oversold. It is likely to bounce back because we are nearing some horizontal support right there and then some more right here. Markets tend to bounce off of these floor prices that are old lows, and so that's a pretty good reason for the market to bounce back from being oversold. Now we can look at an even longer term time frame. So on screen now, I have the weekly time frame. And the weekly time frame goes back to 2014, so it's roughly a 5-year chart. And I'm going to draw some lines on this again. So there's the weekly trend, and again, it runs away, pulls back, runs away, pulls back, runs away, pulls back. This time, when it pulled back, it actually broke the longer term upward trend on the weekly chart. And that is significant, because it's the first time since 2016 that we've had a break of that long-term upward trend line. Now, it actually happened in 2015 as well. Sorry, I drew that terrible. Whoops. Try this again. See how it happened there as well in sort of mid-2015. And what followed was a year and a half of sideways trading. Now, it came up, then it went back, and it came up, but it really didn't go anywhere for a while. And I think that's what we are setting up for in the weeks ahead here. I think the market is, and months ahead, I think the market is ultimately going to bounce back short term, recover a good part of what has been lost, but then ultimately go sideways for a while. It could be for months, and that is going to change the way you need to approach the market. Instead of having an approach where you just sort of ride the index ETFs, I think you want to start thinking about moving out of some of those index ETFs. Not tomorrow, because I do think the market will bounce back and you can get out of them at a better price. But in the next month or two, watch for a bounce back. And if it doesn't break through to new highs, you probably want to start lightening the load on some of those index ETFs and get more focused on finding alpha stocks. And I'll talk about how to find those longer term alpha trades in the Thursday webinar that I will do on investing. This is the very long-term monthly chart. It goes back to 1993, and we are currently below the steepest upward trend line on the monthly chart. Now, the month isn't over. We have a couple more days left, so we could still come back to hold that upward trend line, but I think you have to be wary of the fact that this has been broken. And if we ultimately get a close below support on the monthly chart, as is very close to doing that right now, I am concerned that we could see a pullback all the way, in the months ahead, all the way down to that longer term upward trend line, which I've drawn on there, which is about another 10% downside from here. So to summarize my outlook, I think short term, the market bounces back. That bounce back could last a week. It could last 2 months. Hard to say. When it starts to roll over again, you need to be concerned that we ultimately could take another big leg down and test that longer term upward trend line on the monthly chart. Lots of things to watch for. Now, if you want to keep getting my opinion on this outlook, just go to the YouTube channel, stockscores.com on YouTube. And every week I do an analysis like this where I will give you my prognostication for the near term. And it's a good way, and it's free. I mean, why not do it, right? Just make sure you subscribe to the channel so that you can get alerts when I upload a new video. So again, anyone that wants to register for the course can do so right away, stockscores.com/learn. The benefit of doing it sooner than later is you will have more time to get through the material before the class that I do on November 10th. Anyone that has any questions, my email address is there on screen. Anyone that wants to register for the mentorship before it is gone can email me that way as well. I hope that you have enjoyed the presentation. Again, I'll put my contact information on screen there. And I hope to see lots of you at the upcoming webinars next week, Tuesday, Thursday, and Saturday. Again, go to the Stockscores website to register for those. I want to thank you all for joining me today. Questions. I always forget about questions. So we've got a few that have come in. Let me I have another computer here running with those, and I will do my best to answer these. So where are we here? Yeah, I apologize. I'm watching the presentation as I'm speaking, and I do see that the graphics are lagging a lot. I don't know why that is. We got quite a full house in here. That may be why, but I did record this as a video, so hopefully the video won't have that lag and you'll be able to watch it again to get a little bit more into some of this stuff. Okay, so, and there's a few people that have commented on that. That's unfortunate. So is there a limit on risk? T.Goose, $6 risk on a $30 stock is $20 and reduces number of shares to purchase. There is no limit. Certainly when you have a volatile stock like Canada Goose has been, you really should buy less of it because they are riskier. My approach is to ultimately make every stock have the same amount of risk, whether it's a $2 cannabis stock or Microsoft. What we do is we just take smaller positions in more volatile stocks, and that's how we can control our risk. So on a stock like Canada Goose, yes, you took a smaller position in dollar terms, and that was because the stock was volatile. And that's the appropriate thing to do if we keep in mind that our number one goal is capital preservation. Next question. I'm 65 years old. I have a modest portfolio of selling my business in the next month. Current investments are mutual funds. What would you recommend as a path forward for the next 10 to 15 years? So two outlooks. First of all, I'm not a licensed investment advisor, so I can't tell you, go buy this. I can teach you how to find the stocks that are likely to do well, but you have to buy things that are appropriate for your risk category. And your risk category is going to be different than someone who's 22, who's got their whole life ahead of them to build their portfolio. I would say at retirement age, your primary goal is capital preservation, and you should be buying stocks that maybe pay dividends, that sort of thing. So what I can offer you is I can teach you how to pick stocks, and I can teach you about risk management. I can't tell you buy this stock and this stock and this stock and build a portfolio around that. I can only show you how to pick those stocks yourself because I don't know your situation. I'm not licensed to make investment advice on those sorts of things. But that's a good way to sort of look at it. Next question is $9.99 commission reasonable for swing trading? Yeah, I would say so. You can probably get a little less, but I think if you're, some brokers will charge you $8 for commissions. I think if you're worried about the $2 difference, you're probably not got a very good strategy. So I don't worry too much about commissions. They're all pretty cheap nowadays. When I started trading, I can remember paying $300-400 to make a trade. Nowadays, you're always under 10. Next question. Oh, more screen problems. So I'm just trying to read through these here. When trading U.S. stocks, what are the tax implications for Canadians? It's no different. You're buying stocks that are based on the symbol. You pay your taxes if you have a capital gain. There's no other issues. You don't have to file a U.S. tax return or anything like that. Next one looks like a thank you comment. A few thank yous. You're welcome, by the way. Do you ever see more action in the alpha stock since the market? Sorry, have you noticed through all your years of trading the market change in the amount of volatility in the cheaper stocks under $5? Do you ever see more action in the alpha stocks? So I do think that alpha stocks tend to be lower price stocks because they're the ones that have the story that can be moved by the market. But that's a thing that is always changing. You will find more alpha in lower price stocks. And the benefit of that is they are also more capital. They're good for lower amounts of capital. You don't have to buy as much in dollar terms if you're buying a $5 stock. But I'll trade anything. I mean, I trade $100 stocks. I trade $1 stock. Doesn't matter to me. Is Asian market now good to get in? I'm sorry, I haven't analyzed it, so I can't give you much impression of that. I really haven't looked at any of the charts. If you email me, I can take a quick look at some of the ETFs, but I don't have the screen in front of me for that right now. What times through the day is the market scan updated? The first update is a half an hour after the close, and you can continue to see updates all day long. It's constantly updating. Next question, Apple Notepad 10 not good for trading? I don't know what an Apple Notepad 10 is. Do you mean an iPad? I wouldn't say it's good for day trading. It's fine for position trading. Earlier I said that I use PCs for trading. That's because I'm using specialized software for day trading. If you're not day trading, you'll need a PC. You can use any computer. And whether it's an Apple computer or a PC, doesn't matter. And even use an iPad. I can do market scans on my cell phone using the Stockscores website. So I should clarify that when I said I use a PC because it's good for trading, I was really being specific to day trading. All right, I think that is the questions I needed to answer. I'm sorry if I missed anyone's question. If I did, you can email me. I'll be happy to answer you that way. Hopefully that you have enjoyed this presentation, and I'll see you at some of the others next week. Have a great rest of the week and trade well.